How many times have you heard the phrase commission-free trading and immediately wondered, wait, how does the brokerage actually make money? Thinking face. That question is at the heart of the confusion around platforms like M1 Finance. They tout zero commissions on stock and ETF trades, which is great for the long-term, passive investor they cater to. But that doesn't mean the execution is free in every sense of the word. There are two critical areas we need to examine: payment for order flow and the bid-ask spread. The execution mechanism, not a direct fee. First, let's address the core question: does M1 Finance charge a direct fee for the execution of your stock and ETF trades? The short answer is no, not in the traditional sense. For self-directed brokerage accounts, you won't see a commission fee or a trade execution charge on your statement when you buy or sell a stock or ETF. This is consistent with the model adopted by many modern brokers. However, M1 does make money on those trades through a common, and often debated, practice called payment for order flow, or PFOF. PFOF and the bid-ask spread. PFOF is where the execution costs become implicit, rather than explicit. Here's the breakdown. 1. Payment for order flow, PFOF. When you place a trade on M1, your order isn't always sent directly to a major stock exchange. Instead, M1 routes it to a market maker, a big firm that facilitates trades, and in exchange for routing your orders, M1 receives a small rebate, the PFOF. M1 is very transparent about taking PFOF, stating they typically receive about $0.002 per share for securities, excluding OTC stocks. So, while you don't pay a commission, the market maker pays M1 for the right to execute your trade. This is M1's major revenue source for its investment platform. 2. The bid-ask spread. This is the second, equally important, implicit cost. The bid-ask spread is the difference between the highest price a buyer is willing to pay, the bid, and the lowest price a seller is willing to accept, the ask. When you buy a stock, you generally pay the ask price. When you sell, you get the bid price. The market maker is trying to profit from this spread. The key issue critics raise with PFOF is whether the broker, incentivized by a payment from a specific market maker, always provides the best execution price for the customer. Best execution legally requires brokers to route orders to where they'll get the most favorable terms for the client. M1 asserts they meet this requirement, but since your order is being handled by a third party, there's a potential that the execution price you receive might be slightly less favorable than the absolute best price available on a public exchange at that exact moment. This marginal difference is an indirect cost to you, the investor. What this means for the M1 investor. For the typical M1 investor, who focuses on long-term, buy-and-hold investing with automatic trades executed during limited daily trading windows, the impact of the bid-ask spread and PFOF is generally considered minimal. Because M1's automated process aggregates orders, the market makers handling them can provide competitive execution. Plus, M1's focus on fractional shares and hands-off investing means you're not trying to scalp pennies with high-frequency day trading, where the spread matters most. The bottom line is M1 is not charging you a direct execution fee, but they are absolutely getting paid for the privilege of routing your orders, a factor you should be aware of when you see that $0 commission headline. With that said, thanks for watching.